The International Monetary Fund on Tuesday trimmed its 2023 global growth outlook. It said higher interest rates are cooling activity, but warned that a severe worsening of financial conditions could slash output to near recessionary levels. The IMF report indicated banking system contagion risks were contained by strong policy actions after the failures of 2 U.S. regional banks and the forced merger of Credit Suisse. But the turmoil added another layer of uncertainty, on top of stubbornly high inflation and spillovers from Russia's war in Ukraine. The IMF is now forecasting global real GDP growth at 2.8% for this year and 3% for next year, marking a sharp slowdown from the 3.4% growth last year due to tighter monetary policy. The forecasts were marked down by 0.1 of 1 percentage point from estimates in January. The forecast for the U.S. rose to 1.6% this year from 1.4% from January, as labor markets remain strong. While a major banking crisis was not in the IMF's forecast, the group's chief economist said a significant worsening of financial conditions could recur as nervous investors try to test the next weakest link in the financial system, as they did with Credit Suisse. In a severe downturn scenario, he said global growth could drop to 1%, a level that implies near zero GDP growth per capita. U.S. Treasury Secretary Janet Yellen said in remarks at the IMF and World Bank meetings Tuesday that she remains vigilant to downside risks facing the global economy. However, she said it was in a better place than projected last fall, with energy and food prices having stabilized.
So I do think the outlook is reasonable. It's certainly stronger, brighter than the last time we had the annual meetings in October. Global growth projections are higher than they were at that time. We're seeing diminished inflationary projections and diminished inflation in some parts of the world.